Welcome to this DFI webinar. Today we've got three special guests joining us who are going to share more information about their journeys in the fintech world and also some of the research that has been done in the area too. So I'm going to hand over to those very shortly, but first of all, just a quick reminder, today's session is being recorded. So if you do happen to lose connectivity, we will be sending you a copy of the recording, but you're also very, very welcome to share that copy within your network as well. The more people who see our webinars, the better as far as we're concerned. Just one housekeeping thing to remember. We would love to hear your questions towards the end of the webinar. So the last sort of 15 or 20 minutes so will be over to you guys to direct us with your questions. So please do pop those into the Q&A function. So not the chat, please use the Q&A so that we can manage and get round to as many of your questions as we possibly can do. And for those of you that don't know me before or haven't met me, my name is Sarah Corley and I lead on DFI's community activities. And it's my absolute pleasure to hand over to our moderator today, Maha Khan, who is from Ashion. Over to you, Maha.
Thank you so much, Sarah, for hosting this session for us, and good morning and afternoon to everyone. Thank you for being with us today. We're really delighted to have you with us. So my name is Maha Khan, and I'm the Senior Director at the Center for Financial Inclusion, which is a global independent think tank housed at Acción, and we conduct research and we advocate for evidence-based change to ensure that all people use financial services and products to improve their lives and prosper. I'd like to introduce just briefly our esteemed panelists today. We have Tommy Lola Adejana, who is the co-founder and CEO of Bankly, which is based in Nigeria. And Bankly is the bank to the unbanked with the core mission of digitizing cash and enabling the informal sector to grow income safely and simply. And since starting its operations in 2019, Bankly has gained traction in bringing financial services to the unbanked and has about 13,000 banking agents nationwide and over 30,000 customers. Tommy started her career as a financial analyst in Meristem and went on to her MBA in Singapore and Australia and started Bankly. We also have Puneet Gupta, who's the co-founder of KaleidoFin, based in India. KaleidoFin began commercial operations in March 2018 and follows a bricks and clicks model to reach its customers. So while KaleidoFin operates online, it also works with entities that have a field presence and reach customers at least once a month. KaleidoFin has already signed partnerships with about 40 B2B partners that reach collectively over 8 million customers, and KaleidoFin expects to bring some of these customers on board for its offerings. And prior to setting up KaleidoFin, Puneet was part of the team that set up the IFMR Trust Group. So before I turn to the panelists, thank you, Sarah, for sharing the presentation. I just want to give a bit of background on the IF50 competition. For those of you that don't know the IF50 competition, Inclusive FinTech 50, it is a competition that highlights the potential for FinTech to drive financial inclusion and resilience by identifying, assessing, and evaluating 50 promising FinTechs globally. It was established in 2019, and last year, 2020, was our second year. And amid the unprecedented challenges that early stage FinTechs are facing, we received over 400 applications, and through a rigorous selection criteria and an independent judging panel that you'll see on the slides of 32 judges, we selected 50 winners, two of whom are with us today, KaleidoFin and Bankly. The initiative was funded by our global sponsors, MetLife Foundation and Visa, with support from Acción and IFC, as well as additional funding from Comic Relief and Jersey Overseas AIDS and BlackRock. IF50 is run by the Center for Financial Inclusion, and we produce market-level insights, which draws on the data submitted by more than the 400 early-stage FinTechs, inclusive FinTechs, and we provide insights as to how they're adapting to the current economic uncertainty to advance financial inclusion and resilience. And you can find the IF50 report on our website, which I'll be presenting today. So if we can just go to the next slide quickly. I just wanted to show you a quick snapshot of the 403 applicants that we had. Majority of them are self-funded seed stage group, which can be usually the most difficult group for investors to find, as they may not be listed on public data or have online presence. In terms of product category, a third of them offer credit, and about a quarter offer payments, savings, and financial management. If we can just go to the next slide, just want to quickly, as I mentioned, the pandemic has really underscored the important role financial services play in helping people navigate the effects of the pandemic and lay the foundation for recovery. Tech-enabled providers really can mitigate the impact, the economic impact, by deploying services quickly and efficiently. And findings from Inclusive FinTech 50 applicants indicate that early stage fintechs are innovating rapidly to resolve customers' financial pain points and are operationally resilient, agile, and nimble. And I do want to highlight two findings that we'll be discussing in the panel today more in depth. So Sarah, if you can go to the next slide. Firstly, the pandemic has really enabled fintechs to leverage their unique skills and assets to digitize features, tweak products, or add services to their core products. And so you'll see in the slide, for instance, payment and savings and financial management services grew between December 2019 and May 2020, according to the IF50 data in the early days of the pandemic. And we'll be discussing with Bankly and Kaleidofin, some of the ways that they have been able to offer incentives to save in flexible ways or bundle services on top of their core products to increase their scale. And if we go to the next slide, Sarah, we found that, research, not just us, but research has shown that funding is most likely to go to companies with certain characteristics, namely male-led, founded by expatriates, and located in certain geographic hubs. And findings from our cohort also confirm that many set up headquarters that are closer to the wealthier hubs, far from their operating countries and customers they aim to serve, to be closer to investors. And we also found that female-led fintechs still face a gap in access to funding and have less developed funding networks than their male counterparts, something that I'd love to talk about today as well. And we found that female-led fintechs raise 54 cents for every dollar raised by their male-led counterparts. And the difference is not due to the age of the fintechs, as female-led fintechs are actually receiving less funds on average per funding announcements. But once they are able to reach the funding network, they are able to then grow at equal rates. So Sarah, thank you so much for sharing the presentation. This is going to lead to my first question. And Tommy, it's actually to you. We've just seen some of the gaps that female-led as well as locally led fintechs face in fundraising. So for example, in sub-Saharan Africa, though applicants comprise 30% of the applicant pool, we only 15% of the investment funding, they only receive 15% of the investment funding. And I've just discussed some of the stats on female-led fintechs. And we know that COVID may have exacerbated some of these disparities in fundraising in regions like Sub-Saharan Africa, MENA, or South Asia, which Puneet, I'll also discuss with you. So do you think you'll be able to discuss your experiences in fundraising and the challenges you may have faced that you think are particular to the characteristic of your fintech, female-led fintech, and perhaps your regions? And do you think you had to change any strategies due to COVID-19?
Yeah, thank you, Maha, for the question. Welcome to any of our participants. I think I particularly had to fundraise during COVID, at the core of COVID. So I know exactly what this is about. But one of the things I have to first say is that something has to be done very differently about how investors see opportunity, about how investors review and process opportunity, because investors need to take the time to go beyond the deck, go beyond the data room, go beyond what I would call the science of fundraising. Fundraising for early stage startup is more of an art than it is a science. And so during the 3 to 6 months charting or DD that is expected from an investor, I think investors need to take in the time to getting to know these founders, getting to know the vision, the passion, the tenacity that is necessary for the space. Now, for me, as a young Black, African, female fintech CEO, I absolutely fit the statistics of people who actually have challenges with fundraising. And one of the things I found was that I definitely had to change. I didn't have to change the amount that was fundraising, but I didn't consciously change the kind of investors I was reaching out to. But as time goes on, it was obvious that investors at the core of COVID were a lot more reluctant, and then they were actually playing to what they were already used to, what they were already familiar to. So it was even a much more difficult time for them to do the necessary thing and go and invest in what I'll call the unconventional. The unconventional mean someone like me who do not have an Ivy League background from one of the US top school, or I don't have on my resume writing ex-Google, ex-PayPal, ex-Uber. And so they definitely like went into the usual. But one of the things we found that was unique and different was we kind of started finding traction in places that were unexpected, specific channels like Fintechs within the local space, who understand the local problem, who actually understand the terrain, who are playing in the same space, started being the one who were writing the checks, who were responding faster than typical VCs or impact investors from the West. And I think that was what we found with during my fundraising. Yeah.
Okay, that's really interesting. So you're saying that it was actually some of the local investors that understood the space that were responding to your needs.
Yes, and I would say even fintechs who were within that space, who are kind of like just further on down the road and understood what was required. I think that actually just validated that if they can they understood, they play in this market and they understand what the challenges are. And that's part of what I think investors need to see differently, that they might be missing something by not going through the art of investing and just going through the data, that you wouldn't actually be able to tell certain things differently. Yeah.
Okay, interesting. Thank you for that, Tommy. That is really interesting to hear. And so, Puneet, I'm wondering, for Kaleidofin being based in India, what your fundraising experience has been like, and whether in COVID again, whether your strategy had to change at all. And another interesting thing that we noted about India, and I'll also ask Tommy this about Nigeria, is that India is considered a bit of a hub in the region itself for fintechs, and I'm wondering if that played a role at all in your fundraising efforts.
Yeah, no, thank you so much, Maha, and welcome to all the attendees today. So I think fundraising for a startup is always a challenge, and I would completely agree with what Tommy just said, that it's not easy for startups to raise money, and clearly my co-founder and CEO is Sucharita, and we had some of the same challenges of raising resources. Although I would say that just the fact that we are a 2-people team has helped quite a bit, to be honest with you. The challenge that we faced a lot in general is, like you said, India is seen as a kind of a hub for fintechs. India is a very, very large country. So when you look at even the affluent parts of the country, that is actually larger than the population of many countries put together. So a lot of the money domestically that is being chasing investments is all around saying, why would you want to take the challenges of inclusive finance when you have a very vibrant middle class, upper middle class, young millennials who are out there, who have a lot of challenges with the financial sector? Why would you not build for them? So I would say that in a situation like ours, just to go and say that we want to build up a commercial enterprise which is going to be focusing on inclusive finance becomes really hard. However, I'd like to share one thing. I think one of the things that I really believe about equity investments in general is that it requires a lot of perseverance. It just requires you to get your head down and start working towards it. Beyond the point, people will start to recognize if you're doing good and interesting work. It may kind of stretch you to do bootstrapping related stuff for much longer than what you'd like. It kind of restricts your pace of growth a lot in the early years. But I always believe that you don't have to convince all the 80 investors that you go to. You finally need to convince one of the 80 to write you a check. So you're really hoping that you find the one of 80 quickly. It could be the 80th person, it could be the first person, and that's basically where your luck kind of also plays a little bit of a role.
Sorry, I just realized I was on mute. Thanks. That's really that's helpful. And I'm just wondering, for both of you, actually, Puneet and Tommy, how do you think that investors can be more intentional about their efforts? I mean, obviously, we have this competition to elevate early stage fintechs that we understand may not be on the radar. But curious to hear from you, given the regions that you are operating in, how you think investors can be more intentional.
Okay, let me go first. I think investors actually really be true to themselves. If I want to be impact, if I want to be just cutthroat VC. Now, the reason being that we see a lot of impact investors who, I would say Puneet and I, Kalodofin and Bankley, are supposed to be right up their alley, given that financial inclusion is a long-term game. It actually needs patient capital. It needs you talking to investors who are not looking for 10x growth in 3 years compared to maybe you. It's not like it's not a non-profit, it's not a grant, but you're saying you might have to wait 6 years for 10x growth. However, a lot of times impact investors are trying to compare you who have your head down, really focused on financial inclusion, to those who are actually, there's a lot of things to be done in maybe cutting a slice of the existing banking pie, powering payment, powering cryptocurrencies, and then you see quick growth. And it's now, I think what needs to be first done is investors need to be first true to themselves so that we can actually set them apart. So if I know that you really are not impact, you're just saying your impact, and then I don't know who to focus on. That's the first thing. I think secondly is what I already said, investors need to go beyond the science of it. You really can't tell from just looking at, for an early stage investment, you truly can't tell from just looking at the data room or looking at the pitch deck. You truly need to engage with these founders to understand the vision behind the strategy, the passion behind, to understand this truly. It might take you engaging one-on-one, hearing them when they are not under pressure of a pitch presentation, and then you're able to pick the gems and also be able to sort between just investing in your usual white male or whatever statistics or stereotypes that you invest that you're comfortable with. And I think those are the two things that are important. Being very true to themselves, whether am I truly impact? Because I've seen a lot of impact investors. I like to say that if you torture data enough, it will confess to anything. And I think with impact people, they like to claim impact from anywhere. They see a company which is not actually core, not aligned with their impact, but as long as they can torture it enough to say, yes, it's actually aligned with our impact strategy. I mean, so you can actually make the data, you can make the story tell anything you wanted to tell it. And so that intentionality and just being true to what their vision is, and then just taking the step beyond the data to actually getting to know the founders and the problem is critical. Yeah.
Yeah, I can just add to what Tommy said here. I think the big issue from our perspective, how I think you'll have to give me a second. My phone is just going off.
We'll just wait there for a quick second. Puneet, you're on mute.
Sorry about that. Sorry, my phone was just ringing off the hook, and being alone in a home office is just always a challenge. So what I was just going to add to what Tomilola just said is that from our perspective, I think we share exactly what Tommy said. But the big part which can actually help a lot, at least from our perspective as inclusive finance participants, is just the focus on coming in early into the organization. I think a lot of the challenges that we face, especially for example with entities which are DFIs, is check sizes will be $10 million or $15 million. Typically needs a co-investor along with them to come in and price the entire round. And a lot of the criteria starts to become that you're either near break even or you've already broken even. And I would say that once you've kind of reached that kind of a scale effectively, then you're actually good for everybody in the world. The challenge is really to kind of cross the initial hump in this particular situation, which is, are you able to very much get to the first building blocks? Are you able to raise the first 5 to 10 million? And I think that's where impact investors coming in early to kind of look at this would be extremely, extremely helpful. And I think that's the part where we always struggle with.
Okay, thank you. I'm actually just going to switch gears right now. So both of you have been talking about inclusion, and I presented earlier that we saw that savings products actually grew, services grew in COVID, which we were a little surprised by. And we know that both Kaleidofin and Bankly, your target markets are low income. Kaleidofin, your target market is female, is typically female customers. And so I'm just really curious about how were you intentional about your female target market and how this developed? And then, also, has this customer target market changed during the course of the crisis? If so, how or why? So really curious about that in terms of the intentionality of your target market, who they are, and the value proposition.
So I can go in first. I think for us, this came in quite naturally. We started off largely speaking in my previous enterprise, IFMR, which is now called Dwara Group. We started off with microfinance customers and started to see how could we extend solutions beyond just credit. Given the fact that microfinance had scaled up with women, it actually became pretty interesting to us that a lot of thinking through the household finance and long-term thinking about what are the goals of the household actually is as a question addressed a lot by women. So I think that became a very easy starting point for us. And as we started to kind of build towards how do we take this to scale at Kaleidofin, that entire thought continued with us. One of the things which was also playing on our mind at all of these points was there was demonstrated discipline that a lot of our women clients had shown in terms of the work in microcredit. There was a thought for the family and family's goals. And the third thing which always kind of was bothersome for us was that women across the world have had lower access to assets. Most of the assets are in the name of men. Access to microcredit actually changed the situation. So prior to microcredit, women didn't have assets, women didn't have liabilities. Once microcredit started to happen, a lot of liabilities started to get built in the names of women. And it was almost obvious to us that we needed to actually set that right, start to work on other solutions which create savings, investments in the name of women, and start to kind of get them much more control over their financial lives. And that actually was also an added thing for us. So it made sense more both from the social side of things as well as from a business point of things, and therefore it was a kind of a very natural choice for us.
And so I'm just curious, like how do you leverage this really data to design and deliver products that are really meeting or addressing women's needs? You've been talking about, how you're really trying to respond to their goals and not just specific needs. So curious how you might do that.
Sure. So I think this was very much the founding principle of Kaleidofin. When we were kind of speaking to our customers, we realized that every time we spoke to them about a financial product, like let's say insurance, savings, loans, it seemed that we were not talking the language that a customer understood. A customer, for example, knew that my goal was to send my kid to school or to build a house or to add stock to shop. And I think that was pretty obvious to people. But the same thing kind of converted into saying that going to school is equal to ABC products was not making any sense to the customer at all. So the starting point really was that let's speak in the language that the customer understands much better. The second thing again here was that it was not that customers were not able to get to their goals without access to financial services. In fact, most customers have learned to build their lives without access to financial services. And therefore, the onus was much more on us to build something which was intuitive, easy to understand, and customers started to feel that it worked for them. So what we did was we basically started to collect information on customers, understand their causes of financial vulnerability, their goals, what could be impediment to their goals, and then put all of this information together, use the best principles around building a financial solution and advice for the customer, and came up with a recommended set of products that would work for a customer. But the big change that we made was, let's say, let me make it easier by using an example. So if a customer wanted to send their kid to school, you know that the customer needs to save for education. During the 7-8 years of time when the kid actually will go to school, there could be events like death or disability or accident or healthcare issues, which could derail the customer completely. And in developing countries, education is a very expensive goal. So you need to oversave towards getting there. But at the same time, a lot of our customers are informal sector households, which means that their cash flows actually are very uneven. So there are times when the customer may not be able to save, but more importantly, the customer may need to borrow. So this basically means that the customer needs a savings, 3 kinds of insurance product, and a loan against securities at the very best. Now, these are 5 products. We came up with exactly these 5 products, bundled them together in a solution called Lakshya. Lakshya basically literally means the goal. And now we sell Lakshya solution to a customer. The communication to the customer changes to saying that you save towards your goal. If something happens to you, you will still be able to send your kid to school. So insurance has gotten converted into promise, and you can skip installments and take a loan against your investments whenever you want. It becomes really intuitive as a solution rather than it being sold as 5 products. It's now sale of 1 solution. It becomes a language that the customers understand better. And we're able to customize it to each customer by looking at their profile and using the power of data science and artificial intelligence to customize solutions right at the level of each client.
So actually, that brings me to a point where you're talking about leveraging data and artificial intelligence. We also know that sometimes data and artificial intelligence can unintentionally lead to bias. And so how are you really understanding that, how are you taking that into account, especially if you are targeting informal workers or women where this may come in?
So I think one of the big things to do in this case is to be aware that it's possible to get bias in and make sure that different people are looking at it at all points of time. So one of the first things that we did at a model level was to eliminate certain factors which are known to cause bias and which were beyond the hands of the customer. So gender, age, community, caste, religion, we knew that each one of these are not in the hands of the customer at all. So let's kind of get rid of it. So we didn't use it for modeling at all in the first place. Age is important only from the perspective of insurance calculations, but not in terms of loans or some other stuff. So some of these variables we just excluded. That was point number 1. The second thing that we did was we start to look at excluded customers, and we started to look at who was being excluded from the customer group and were they also mapping to a few variables. So not only were we looking at selected customers, we were also looking at excluded customers at all points of time. And if it was kind of strongly getting looked at or lumped at with a single variable or 2 variables, we started to identify them because that could be a potential cause for bias. The third thing that we did in this case, Maha, was that we opened up some of our algorithms to like-minded entities. For example, we started to work with Women's World Banking, and they have actually a team which is looking at algorithmic biases. And we actually opened up our algorithms to them to start to see if they could actually help us think through if some biases are still there. And sometimes just externally, somebody looking at it makes life much more difficult in some of this, but makes it far more open and transparent.
Okay, yeah, I can imagine, but that seems like a really thorough process. One of my last questions in this segment is really, again, around COVID. So you said, you're offering this bundled service, savings is one, insurance. So did you see a change in appetite given people are going through a crisis, disposable income may be less? And so curious if, how you had to, whether you had to sell your services differently, if you had to add new products, customer acquisition, really interested in hearing about that.
Yeah, Tommy, do you want to go first?
Yeah, okay, let me go first. Let me give you a break. So for us, we did see a difference. So our target segments were amongst the most hit during COVID. And because we are dealing with informal sector, market women, artisans, daily workers, you're talking motorcycle workers, you're talking people they call in India tuk-tuk riders, you're talking all of these people that kind of make mobility or day-to-day moving around and food possible. Now, when COVID hit and the lockdown happened, a lot of these people's daily income were affected. Now, one of the things we found was when during the lockdown, that was roughly about towards the end of March to April, we saw a dip in the savings pool. And what that meant was that people were actually coming for their savings more because they then need this emergency funds for their day-to-day while trying to survive these unusual times. For us, I think it was great because this was the whole point of teaching them financial education, knowing that you can't spend everything at once, especially for Nigeria, who we have more of a delayed instant gratification culture. I think that's a bit different from India. So people tend to want to spend as they make money. So we're teaching a new behavior. And I think what that showed them is that I kept this money away and I was able to survive during the time. And what we also then observed is that within a quarter, we started seeing that they were able to start bringing back their savings, and it rose up to pre-COVID times. Now, there are two main things we found there. The first was that made us quite excited there. The first was that we were consistently gaining trust with these people to know that even if you keep your emergency fund here, when you need it the most, you're able to trust the system will provide the money, and then you'll be able to access your funds. The second thing we then saw is also how to layer the right incentives. What are they needing? What kind of wipes the informal sector's funds or money or savings the most? It's usually maybe a sole entrepreneur or sole a breadwinner in a family who then suddenly has some form of health issues. So we started layering the right incentives, kind of health insurance, layering credit, layering even some form of just adding layers to help them grow their income, protect their income, and also protect themselves, protect their health while protecting their income. And I think this were the things we observed. So the first added deep in their savings. Then as they got comfortable with life with COVID during the COVID lockdown, they started learning how to continue their businesses and then started bringing their savings back. The second thing we found was that local remittance, domestic remittances grew significantly. And I think that adds to the point Maya made about services growing. A lot of local banks or bank branches had to close due to lockdown. So people actually gravitated towards community banking. So a company like Bankly that does agency banking took off significantly during that time because people within the towns or the cities needed to send money home to the people that are more dependent. And so these domestic remittances were happening a lot. Access to cash withdrawals, given that 90% of transaction in Africa is still happening in cash. So people needed to withdraw cash. And so they are going to this agent networks to either deposit cash or to withdraw cash. And so this services improved significantly with COVID while COVID happened, while savings went down and then came back to pre-COVID levels towards the last quarter of the year.
That's really interesting. I just want to pick up on like 2 points that you talked about, Tommy. You know, as I mentioned, we saw savings grow, and one of them, and we figured what you were saying is that people, you know, fintechs are bundling services. So you talked about the importance of trust and education with your customers, which it's a niche group. And then you talked about this bundling of services. So how are you really building trust in this challenging time? Was this, you know, with lockdowns and maybe limited customer interaction, I'm just assuming here, and how are you able to really navigate and understand the products that might meet their needs at this time? And how easy was it to shift and pivot all of this? It seems like, you know, there's a lot sort of going on.
No, so there wasn't, I need to give a little bit more clarity on Bankly. So there wasn't specifically a pivot happening. Bankly is growing through a 3-phase process. Now, the first phase for us was building the distribution, building the agent network, because we're like, if you're going to bank the unbanked, the reason why the traditional or the legacy banks can't reach these people is the cost of building an old banking structure in places that might not be able to cover the cost of the overhead enough for that branch to be profitable. Now, how do we do that efficiently, affordably for these people whose income is not as much, is smaller, and then you need to serve them cheaper so that you don't burden them with high cost of transactions. And so what we did was realize that the first thing we needed to do was build the distribution who was going to act like branches, but in a more cheaper and efficient manner. And the second thing was also they would be like tellers in the bank. So we were in that phase when COVID hit, which was a good thing because at that phase, just before COVID hit, we also understood that they needed to serve, like they needed to have point of sale services and all of that. Now, the second phase for us was to be more customer acquiring. Once you've built this distribution location, then you can now channel traffic to those locations and tell customers you can then get your financial services at this location. So I think the phase we were at was helpful. So we just honed in on that phase to make sure that those agents were performing the services that was needed at that time. So it wasn't more of a pivot, it was more of a focus area. So we then said, let the savings or the customers storing value be more organic rather than being something we were deploying resources to during COVID. And that was what helped us significantly to just hone in on the agent network. And we saw the growth. As at December 2019, Bankly was about 2,000 agent network. As at December 2020, we grew to 15,000 agent network. So you can see how that was actually, I just think it was preparation meeting opportunity. We were actually going in that direction. We just had something propel us or accelerate the growth further.
Great. Well, congrats on the growth. That's great to hear.
Thank you.
And Puneet, so just curious about your experiences. I know when we last spoke, you had mentioned something similar. So I was surprised, given the regions are different, that, you know, savings dipped and then sort of it went back and increased again. So I'm curious to hear about, you know, how you did address needs during a challenging time.
Yeah. Largely, I would say very similar experiences to what Tommy just pointed out. I'm just going to build on top of that what we had to do slightly differently. I think we used the opportunity at our level to be able to use and build a lot of trust amongst our customers. So one of the things that we did was we called all our customers to say that their money is safe with us. And if they need to draw out the monies at any point of time, they can just give a call at this number from which they're receiving the call, and the money will be in their bank accounts in 24 hours. So we underscored the point that money is available. And I would think that that actually gave a lot of assurance to customers, and customers actually did not withdraw. They started to think that this is a good last resort. If they have no other access to money, they can always easily access this kind of cash. But what we also felt over a period of time was that the big change happened in the credit markets. A lot of these customers had access to credit, and this was one of those rare situations where credit disappeared for a very, very long period of time. The decisions of the Indian regulators also to give compulsory moratorium made it very, very difficult for lenders to actually get a sense of who was defaulting, who was going to pay. So a lot of that entire history became vitiated from a lending perspective. And it started to actually take away confidence of a lot of lenders in being able to give new loans. So from a customer standpoint, I think it added to this thing to say that I need to have a buffer. I can't only rely on credit. And we started to see some genuine need from the customer to start to save more informal sources. So that was one thing that we started to discover. The second challenge that happened in our case was that while there was a need to be able to save more, income effects had really come in, and therefore we had to think about starting much smaller with the customer. So we had to work on thinking through much easier entry of the customer into our solutions, much lower access points. But the second thing also that happened was because of lockdowns, cash and points became much more difficult. So just to kind of go to even the nearest banking correspondent touch point, which was 3 kilometers away, was actually not easy. So we started to create our own channel, which was more a customer referral plus channel, where we got some of our own customers to start to become agents and therefore help customers access service not 3 kilometers away, but within their own street. So even in the heights of lockdowns where mobility was generally poor, but mobility within the street or within a couple of streets was very high. So we had to actually invest in a channel to be able to create better and closer service points to customers. It also added a revenue opportunity to customers who otherwise had a revenue hit. So it also made some of these customer agents to be really, really excited about doing this. The third thing that we started to do, Maha, and this was really, really exciting for us, was that a lot of work that we had done on thinking through creation of solution bundles for customers, we started to see if we could use all of the data and the power of all of the work that we were doing on artificial intelligence to be able to build credit scores to offer to some of the lenders and say that this might be a good opportunity for you to kickstart lending again, especially in the low confidence environment that has been built. We were always working on this credit score, but we were able to actually pilot it very, very quickly just post lockdowns. This was taken very well by the market. We today have 8 NBFCs who are using our credit scoring models. We've actually used it to disburse nearly $300 million over the last 9 months of our operations now. And it's just been actually amazing. Our collection efficiency is almost 8 to 10% higher than the best microfinance companies in the country on the basis of a credit model. And a lot of entities actually started to use it to get back to credit really, really quickly. So I think our response was much more to say that let's work on understanding what could help customers rebuild their lives during this time, and getting access to credit was an important piece for especially enterprises, even for people to kind of get back to hawking business, get back to shop stock. Some of that stocks had depleted completely during this time of COVID, and they were actually using the incomes to be able to use up at home rather than rebuilding stock. So it had to be kind of brought back. So that was largely speaking our approach post the entire COVID situation. It got us 2 new products that we are offering. One is the credit scoring and one is digital payments. And from a customer standpoint, we added a new channel, which is the Customer Plus channel. So lots of new stuff is what we had to do, but it has left our business model much stronger.
Okay, that's really interesting. You know, sometimes adversity inspires creativity, and it seems for both of your fintechs, that's exactly what's happened. And from what also I'm hearing from both of you is really that understanding the customer and the data that you leverage actually to do that, and then drive through products that will increase that will help them and their well-being. And Puneet, was interesting as well about the partnership opportunities that you said that have opened up. As well as with you, Tommy, in terms of the increase of your agent network as well. So I think that is really great to hear. I know we have some questions, so I thought we could get to some questions before and I might ask you a question myself. So we have an anonymous person asking, Tommy and Puneet, can you explain a little bit more on how you're able to leverage the savings from the customers? Do you also lend, or do you invest in other vehicles? We've just heard that you are also lending Clydofin. And how did this change during the pandemic?
Okay. To answer the question, yes, lending is always, for the target segment we are targeting, lending is always a value add, because more often than not, so Bankly was trying to serve the segment that saves with thrift collectors. Now, these thrift collectors, meaning that people are saving in cash, and then they have to take loans from loan sharks at predatory interest rates. So if you're going to digitize their savings, you're going to have to use, so the next phase for Bankly is what we call the data as a service. Either we then learned off our own balance sheet, or we provide the data to lending companies to say, you know what, this is a huge market, and what you need to create a credit score to determine the credit profile of your lenders is what we are providing for you. So we have this number of customers who we believe are eligible and right up your alley for lending. So lending is a natural projection after savings. And so what, like I mentioned before, the savings like we saw was growing and then came back, then actually continued growing after people adjusted to this newness of COVID. And then I naturally would say that data as a service, which Puneet has rightly, actually, I don't need to spend more time there. Puneet has broken down as credit, we're using AI and data analytics. We don't do that, but we work with maybe like a company like Clydofin to kind of like use the algorithm to offer, to aggregate lenders to the platform. So if Maya is trying to, is saving and needs access to a loan, Maya can take a loan off Bankly, but through maybe the lender is entirely not Bankly, and then maybe Clydofin is the engine. So we think collaboration and just being specific into what we know how to do, which is serve the customer, being the front end and being the distribution, is what we have been able to do over the period.
Okay, cool. Thank you. And actually, there's another question I see, actually, Puneet, that you're responding to that, so I won't ask that question. But there's another one on you guys have talked about the new use cases. So someone's asking, you know, have you seen new use cases for financial services in 2020, and I believe you guys have. But do you think these will persist beyond the COVID environment? Sorry, go ahead.
No, I can take a stab at this. So this is really hard, and it's almost like saying that we're kind of staring into a crystal ball. India had a little bit of a big shock event in the form of demonetization, where this government actually said that all of the currency is not going to work now. We need to change the currency completely. It created a system-wide shock, which basically meant that cash was no longer available. And in the immediate period, we saw a significant jump in the digital transactions. But the moment cash came back, the digital transactions actually start to reduce very quickly, especially for the informal sector customers. For the middle class and upper middle class segment, I think it's continued to grow from there. But for the informal sector customers, it actually kind of came down. My overall view on this is that much of the response basically would come from the fact that how long is the situation going to persist? I know several entities right now are making real investments in technology, in digital payments. Demonetization was a small enough event where things came back very quickly, and therefore people hadn't really made investments. They were still contemplating making investments. I think this one looks different. I know several entities who have actually made some of these investments already. What is kind of going to be the big driver of whether these will continue or not is going to be what is the kind of success that they're seeing, and economically, does it make sense for them to continue with it, or just think of these new investments as, well, no harm in writing them. I think if it continues for a little bit more time, I think we'll cross the tipping point and then they'll become more permanent. But if with the vaccine and others, if it starts to open up quickly, I think we will slide back quite significantly from where we are.
Okay. Tommy, there's actually thank you for that, Puneet. Tommy, there's a question to you from Peter at the World Cocoa Foundation in Ghana. So after the easing of restrictions in Nigeria, did you observe a significant increase in growth in savings volumes as compared to the same period without COVID? And I believe you mentioned you saw a dip and then an increase again. But what are some of the incentives that your agency put together to increase patronage by users and increase the number of agents?
Yeah, thank you, Peter. Like I said, I think the phase we were at is very critical to note at that time. And I also like to add that the segment, the financial inclusion segment is actually not one single segment. I like to break down the segment into three parts of a pyramid. At the top of that is the banks who still need inclusion in terms of maybe lending. At the middle is where you have people who need inclusion in terms of cash digitization or maybe some form of payment. And at the bottom is those who need literacy and all of that. Now, when it comes to the lower end of the pyramid, savings didn't grow, which was what I said. We saw that most people needed their savings at the time when they couldn't make money as they typically would. A commercial motorcycle rider who goes out and pick customers up and down the road. When people are all logged in and people are not going to work, who is going to be his customer? And if he doesn't make money for the day, how is he going to feed? So savings dipped, but we started seeing recovery. However, it is important to know that our goal at that time was not in driving savings, but was just to make sure that we closed in on making sure that those point of service agents were available, secure, and able to serve people who needed access to funds like domestic remittances and all of that. Now, when he asked about the incentives we're able to give to the agent, I think the first thing, as always with agent, has always been the margins they make, and what we just make sure that we are as competitive. The agent control the market currently, unfortunately, and so they get to have very low the operators get to have just very low margins, and they are able to mark it up as much as they are, and that works for them. But to then separate what then allows an agent choose us over any other competitor, maybe the support, security, and just consistent information of how to protect themselves during COVID, how to get, and before COVID happened as well, we always give some form of float for business, because for agency banking, liquidity is a problem. So access to liquidity was something we've done over time to help even them starting up micro entrepreneurs who wanted to step into this side of the business, knowing that I can access the required liquidity to start this business was helpful. But it will be interesting to hopefully maybe share more information with the Center for Financial Inclusion towards the end of the year, because now we're evolving into the very active customer acquiring side, pushing out the incentives, given the data we've gathered during COVID, pushing out all the right incentives. So it will be interesting to see how our customers respond to these new incentives while we roll it out within the next few months. Yeah.
And we'd be really happy to have any of your research. I think there's a great question as well for both of you. These questions are coming in pretty fast. Experts predict that the pandemic will be followed by a recession, economic recession, if not a crisis. So do you think that the current growth you're experiencing may change, and how are you preparing for this? Another sort of futuristic.
Yeah, I think that's a fantastic question. And I think that's right up what we are trying to do. Now, given that, what I keep thinking is that what's going to help my customers grow their income? Because financial inclusion starts with economic inclusion. How am I going to help that farmer reduce his cost? How am I going to ensure that he makes more money from his goods so that he can actually survive better when this recession happens? It might not become wealthier, but it doesn't become poorer, right? And I think those are the things that are part of the incentive structure that we're going out with. So people will truly have their income protected and have their income grown as a result of this product. And that's actually what I'm excited about rolling out this year. So do I think the current growth we're experiencing may change? No, I do not think so. I think that the growth, what's happening will continue. But if you're already thinking about it the way we are, people just need safe spaces. People need where they can actually say, everything is happening. The recession is happening right now, but where can I ensure that I protect my resources? Where can I ensure? And that's where they would gravitate towards. So I think that the growth will actually continue in the similar trend.
Yeah, Puneet, interested to hear from you in terms of the growth and also, actually, I'll leave it at that. Yeah.
Yeah, no, sure. So so in the short run, I think what you're saying is completely right. I think we are seeing a lot of activities which used to involve informal sector households have actually changed quite a bit. So while some of the indicators have already started to look pretty positive, but I think the growth is in completely different sectors altogether. So things that were employing our typical informal sector households, for example, construction industry, people kind of doing odd jobs, kind of calling people home, drivers, hospitality industry, I think all of them have slowed down quite considerably. And I think this is going to continue for quite some time. So I think that's basically what we see as a current situation. We're also starting to see green shoots already. I think this has kind of resulted into two things that we are witnessing here, at least in the Indian context, is that during this time, at least for the middle class households, the average expenditure went down quite dramatically. People were not going out of houses, people were not stepping out of houses, and overall savings rate in general has gone up. These were not households which also saw a significant income impact. People were working from their homes in a lot of these situations. And right now, the new wave that we are starting to witness is consumption fueled by this particular population. We are already seeing auto industry, for example, rising. We are starting to see air travel coming back into picture. So some of that has already started. And our sense is that just higher disposable cash at this point of time will start to actually bring back some of this back to normal. When it comes to rural households, and which is something that we found, it's already shown a very high degree of resilience, simply because of the fact that the dependence on the external sector already was actually pretty low. So inward remittance market has slowed down, but the production within the local loop, production of food, production of things for the local environment actually has caught up quite a bit. So at this point, and perhaps this is optimistic me, who believes that we might not actually get down to a very bad situation at an economic level, but I think it will take time for us to get back to normal. So there will still be some time before incomes of our customers start to kind of get back to where they were.
Right. Yeah, so it's you have a little bit of more of an optimistic view. And I think that I'm sort of trying to combine a couple of questions here. So we, you know, markets are shifting. You talked about growth and the space really booming. So just wondering how the competition has changed, if at all, for you guys as you sort of pivot your models and also sustain your operations, and whether that has had any impact as well.
Competition exists, I dare say definitely, especially in the fintech space, exists for both Nigeria and India, because these are fast growing. The attention is, investments are going into fintech in this space, the attention of investors are there. And so naturally, existing financial institutions, entrepreneurs start to look in the direction where the money flows. But so is there the challenge of competition? Yes, absolutely. But for us, for me in particular, for us, my co-founder and I in Bankly, what we've realized as three things that's been our strength is our deep research into this space and understanding that we believe that, of course, time might not be a resource we have. And that's, but we have an understanding that a lot of people do not have about the space. Secondly, like I said about the pyramid of the financial inclusion space, at the top of the pyramid in Nigeria, so I'll say we have about 100 million adult Nigerians. Adults, I'm talking nobody, between 18 to 50 or 60. We have 100 million of those. At the top of that pyramid that are banked is about 35 million. Data says 40 million BVN, but exclusively is between 30 to 35. Let's even say it's 40 million. We do have not less than 10 banks, much more, profitably serving this 40 million segment. Talk about it, Zenith, First Bank. And all of these banks have come from different generations. We typically have about 3 generations of banks. We have the First Bank, which has been existing for 100 years, to the newer ones who is just existing for a decade plus. And all of these people have come into the space that seem like there are huge competition in this space, and they've been able to create a niche and solve a problem for a particular segment of people in a way that these people say, you know what, I want to stick here. And so you've seen a wide breadth of these people within a 40 million space. Now you have another 60 million, right? So let's even say you can't have the same number of players because of the volume of funds at the top of the pyramid. So you have another 30 million at the middle of the pyramid, and I call it the underbanked. They are not the underbanked. And you have at the bottom the unbanked, absolutely. And so if you're talking about the underbanked, you would have not less, between that space, not less than 3 to 5 players at least serving those markets. So will competition come? Yes. Do we think that we'll be able to cut a decent slice enough to make a dent in the market? Absolutely, yes. Do we think we have what it takes? And of course, what it takes is what a typical investor will be looking for. The understanding of the problem, how you're going about it, the team. Access to finance is a very critical one. Like Puneet said, it accelerates you when you have the funds to do the right thing. And I think thankfully we just closed our seed round, so we can hit the ground running pretty quickly. But competition would always be a problem, but also understanding that it's not going to be a segment that it's not a winner takes all segment, just the way in a country like Nigeria, so you have like at least 3 to 4 telcos who actually were able to cut a huge market share. Mm-hmm. And that's what's going to happen with this space as well. At least 3 to 5 competition companies that will catch a share.
This is all really interesting, and we have more questions, but we are actually...
I just want to add one thing to this. Yeah. I think we've looked at it as a complete opportunity set. So rather than protecting our turf as KaleidoFin, we actually added 2 new services. So for example, we got into payment space for the informal sector, and we started to enter into thinking through credit scores for the industry. So if you were to see the competition metrics for, let's say, people who were doing credit scoring models, we were not there in the list today. And I would say today we are on the top of that list. If most people in that segment, you were to ask them who's the biggest competition, they name us. Similarly, on the payment side, we never had even ambitions to get into payment space at all. We thought it was a very crowded space, especially in India, and it's very hard to make an economic model work. But today, most of the payment services companies for inclusive finance space call us as the biggest competition. So we've actually been the competition in some of these industries. And this was just about, as a fintech, as a startup, one of the biggest things that you have is your speed and agility. And I think I would actually encourage everybody to think about how quickly can they move on this.
Yeah.
Really great points. And Sarah's on, which means that we are over time. But I think this has been a really, really fascinating conversation. Tommy and Puneet, it's been really great to have you guys share your experiences. Like you were talking about the agility, the innovation, the data you're using to understand your customers and the growth that you've experienced. And we hope that, that continues as well. And thank you so much to the participants. Sarah, I'll hand it over. There were some questions that we didn't get to, but we can try to do that later.
Great, and thank you so much, Maha, for moderating and hosting today. I've really appreciated being able to sit back and enjoy and really listen to what was said. And just to sort of close, Puneet and Tom Loda, what just was so apparent for me as I was listening to you is A, your passion, but B, how, the whole way you guys have set up is thinking, not just where's the gaps, where can I make money, where can we fit in? It's actually almost the exact opposite. So, who are my customers? What is their economic growth? And what is their resilience? What products what are their issues? What are their concerns? What are their goals? And from that, then what products? It wasn't leading with products, it was leading with what do our customers need? And no wonder you guys won that competition, and no wonder you've got the funding that you have, because from what I can see, it's incredibly well deserved. And I just hope that we'll have you back on a webinar, maybe in a couple of years' time, where you can be telling us more about how you've continued to grow and what your success has been. So thank you very much for taking the time today to share with us your thoughts, your journeys. And we look forward to seeing you all on a webinar again soon.
Yeah, thank you, Sarah.
Thank you so much.
Thank you.
So much.
Thank you everyone for joining us. Bye, everybody.
Bye.
Okay, bye-bye.
Bye.